while watching the debate between Kevin O'Leary and Hassan about how Kevin was promoting FTX. Hassan mentioned a book called The Simple Path to Wealth.
When you give financial tips, it's like a doctor giving a diagnosis to a patient they can't even see. You don't know the number of people that you're inadvertently
let me tell you
or advertently hurting.
Let me tell you.
Sure.
Do you think I should go to high schools, as I do, and talk to them about financial literacy and about credit card debt and about stocks and bonds? Is that a good thing to do?
Totally. You should give them J.L. Collins' book, The Simple Path to Wealth, and one of the addendums should be, turn off any program that I'm on.
So I just had to check it out, even though I figured it would probably be a book about investing in index funds, which it is. This book is all about investing in the simple and easy way, which can be summed up as spend less than you earn, invest the surplus into index funds, avoid debt. And the investment is the total U.S. stock market. VTSAX is the mutual fund mentioned throughout this book. And it's also how you invest in the total U.S. stock market. VTI is the ETF version of this fund. This is my review of The Simple Path to Wealth, Your Roadmap to Financial Independence, and A Rich Free Life by J.L. Collins. VT Sacks and relax. One of the core concepts of this book is that stocks always go up. According to the author, stocks are the most powerful and successful investment class in history. Now, some people may hear this and roll their eyes, but we have decades of history to back this up. If we look at SPY, which tracks the top 500 companies in America, since 1993, it has only gone up. During that time, we had dips and market crashes, but long term, it just goes up. That's why we invest for the long term. It's not going to be a smooth ride, but when you zoom out the chart, it just... And if that's not long enough for you, here's a chart of the Dow Jones Industrial Average, dating back to 1983. And for fun here, here's another chart of the Dow Jones Industrial Average, dating back to 1915. The gray lines represent recessions. We have over 100 years of history to look back on. A history filled with market crashes and recessions. Long term though, it just keeps going up. Now, full disclaimer, investing does involve risk. The next 20 years could be horrible for the stock market. Then again, maybe AI, robotics, and new technologies will end up getting us to new all-time highs. Maybe the US market will face trouble in the coming years. So ultimately, you have to form your own conclusion. The author does believe that the market will always correct. There will be crashes, even times when your wealth is cut in half. Still, historically, the market always recovers, and will likely continue to do so moving forward. Which, looking at the history of the stock market, this has been true so far. To understand why stocks always go up, we have to look at what stocks are. They are not just pieces of paper or digital numbers on a screen. A stock is a share in a company. You are buying a piece of a company. When you buy an index fund, you're buying several companies. When you buy VTI or VXSAX, you end up owning a piece of virtually every publicly traded company in America. Companies that are constantly competing against each other. New companies that are replacing legacy companies. You get to own a piece of this. Many of the top companies in America are also international companies as well. So just buying VTI or VXUS, you end up getting international exposure as well. The reason why it always goes up is because it's constantly evolving. If an old company gets stuck in their old ways and they no longer innovate, a new company will come up and replace them. A new company will come up and disrupt them. Remember, a company can only lose 100% of its value, but how much a company could actually grow is theoretically limitless. So why not just buy individual stocks if they always go up? I mean, index funds are just for lazy people, right? According to the author, no, index funds are for people who want the best results. And history has shown this to be true. Individual investors and even professional investors consistently underperform the market. And the further out you go, the more true this is. They may be able to outperform in the short term, but consistently, time and time again, long term they end up underperforming index funds. Funds like VTI, S&P 500. The thing about it is that people are really bad at stock picking. The vast majority of people will fail to get the 10% average returns of index funds. Even Warren Buffett thinks that index funds are the way to go. Warren is a fan of S&P 500 index funds. Funds that track the top 500 companies in America. The author mentions how investing in index funds isn't exactly sexy. Still, the results of index funds speak for themselves. And when stock picking, you're playing a game that has a very high likelihood of failure. If you want to stock pick, consider making index funds the majority of your portfolio and make stock picking a smaller portion. At the moment, my portfolio is just one stock, which has served me well so far. As time goes on though, the plan is to put the majority of my money into index funds, with a smaller percentage into stock picking. Just be aware of index funds, and be aware that the chances of being successful with stock picking is very low. And the longer the time frame goes out, the higher the likelihood of failure. One way that people lose money in the stock market is by trying to time the market. Not even Warren Buffett tries to time the market. Funny enough, index fund investors end up underperforming the market as well, because they'll try to time the market and they'll end up selling too soon, and end up having to buy at a higher price. The author doesn't buy international due to currency risk, accounting risk, and the fact that the largest companies in America are usually international as well. Other reasons would be rules and regulations that America has in place. He's not against putting money into international. If you wanted to add in some VXUS, which is basically VTI for the international market, you can. Or you can just buy VT, which is the total market that has international and also US. The author encourages the reader to form their own opinions when it comes to international exposure. This book is actually a pretty good read, but it's still a book about finance, investing, stuff like that, so it can get boring at times. Another con is that you can actually find all this information online for free. There are plenty of forums online that talk about maxing out your tax advantage accounts through index funds. Another kind of potential con is that the author has a strong bias towards Vanguard. He gives good reasons why. Still, some younger investors may actually be more likely to invest if we recommend something else instead. If we recommend a brokerage that has a better app and better user interface. I mean, it's 2023 and you can't even buy fractional shares on Vanguard unless if you're buying one of their ETFs or mutual funds. My biggest con with this book is that he doesn't really go over how to actually retire early. If you invest in tax advantage accounts, you get penalized if you try to take that money out before you turn 59 and a half years old. Which there are ways to actually get around this, but the book doesn't go into much detail about it. He at least mentions it and does have more information about it. But you have to click on a link and read it on his website. I strongly dislike when authors do this. All of the information should be in the book that I paid money for. I shouldn't have to go to your website in order to actually read information about this. Now let me be clear, he doesn't leave out a ton of information. This is really the main thing I have an issue with. He doesn't abuse trying to get you onto his blog. So don't let my cons dissuade you. The overall package of this book is great, and it's filled with a ton of information.
Hey, real talk? You should have one class at Harvard. It should be 10 minutes. Listen to me right now. Listen to me. Put your money in a Vanguard portfolio, VTSAX, or S&P 500. Maybe do a bond position right now because it's giving you 4%. Set it aside and turn off Squawk Box.
This is actually one of the best books you can read when it comes to investing for your retirement. Don't expect to get rich overnight. This information is real. It's not a get-rich-quick scheme. Even though I gave a summary, it's still worth reading. There are parts of the book that I did leave out. And reading the book and actually hearing the guy's experience with all these market crashes really puts things into perspective. I'll have an Amazon affiliate link down below to the book. If you're interested, feel free to check